Let's talk about how China's first 2 months of economic data in 2026 were packaged to look far better than reality. Because, quite frankly, the level of creative accounting going on here is really something. In the first 2 months of 2026, the technocrats working under Xi Jinping pulled out every trick in the book to manufacture the appearance of a strong economic opening. They took every playbook they've refined over decades and deployed it all at once. If I had to sum it up in one sentence, it would be this. They shoved every positive signal they could find into the same 2-month window. Growth that should have been spread across different months and different sectors was artificially crammed into a single statistical reporting period. And that is why the headline numbers for January and February actually looked not terrible. Industrial value added was up 6.3% year over year. Retail sales grew 2.8%. Fixed asset investment was up 1.8%. And total goods trade surged 18.3% in yuan terms. These figures all beat market expectations. So how did they pull it off? The economic apparatus stacked 4 layers of artificial boost on top of each other. Let me walk you through each one. The first layer was exploiting a spike in upstream raw material prices to trigger panic-driven restocking. The logic here is straightforward. When upstream commodity prices start climbing, the first instinct of every Chinese manufacturer right now is, if I don't buy now, it is only going to get more expensive later. And since actual end market demand hasn't really picked up, companies are just stockpiling, locking in raw materials, front-loading production, filling warehouses to the brim. That means production, procurement, and shipping all get pulled forward at the same time. The January-February industrial output numbers looked solid, especially in equipment manufacturing and high-tech manufacturing, but the main driver wasn't genuine demand. It was supply chains reacting preemptively to cost pressure and policy expectations. In other words, companies were hoarding materials and goods because they were scared prices would keep rising, not because customers were lining up to buy. The second layer was front-loading policy, stimulus, pushing credit, financing, and project approvals all into the early months. This one was the most significant factor in the first 2 months. Aggregate social financing, which measures total funding flowing into the real economy, hit about 9.6 trillion yuan on a cumulative basis. M2, the broad money supply, was growing at 9% year over year as of the end of February. At the same time, fiscal authorities were emphasizing larger-scale government bond issuance and earlier spending schedules. So the math is simple. Once the money is out the door, local governments can start spending, projects can break ground, and priority industries get their financing first. That is exactly what we saw. Infrastructure investment clearly outpaced overall investment growth. The reason fixed asset investment managed to turn positive at all was mainly because government-backed projects and selected manufacturing sectors got preferential access to capital and policy support, and they rushed to start work. The key point here is that current policy is heavily tilted towards specific industries, infrastructure, equipment upgrades, high-end manufacturing, key supply chains. Local governments and firms in those sectors pile on the leverage. First, social financing numbers go up. And then the broader economic data follows and looks better, but what is actually heating up isn't the whole economy. It is just the slice that is getting targeted policy attention. The third layer was the Lunar New Year calendar shift, which changed the rhythm of production in the January-February window. A lot of people might assume that a later Spring Festival would mean a later return to work, and therefore worse data. But that is not how it plays out when the Statistics Bureau reports combined January-February numbers. In 2025, the Lunar New Year fell in late January, which means factories were already shutting down by mid to late January. That chopped into January's output, and February was mostly a slow recovery month. But in 2026, the holiday didn't start until mid to late February. That meant January 2026 was essentially a full production month, and the first half of February was still active for shipping and manufacturing. Before the holiday pause, after the break, there was a concentrated burst of activity to catch up. So even though the post-holiday restart came later this year, the earlier weeks gave a much fuller January, and the combination of pre-holiday rushing plus post-holiday catch-up meant the January-February data was naturally set up to look stronger than last year's. That is the calendar illusion built into this year's numbers. The fourth layer was a temporary window of lower U.S. tariffs that created a rush to export. In the first 2 months, China's total goods trade was up 18.3% in yuan terms, with exports up 19.2% in US dollar terms. Exports surged 21.8%, the fastest growth in over 4 years. Those numbers look like an absolute trade bonanza, but the more realistic explanation is this. In February 2026, the U.S. Supreme Court struck down tariffs imposed under the International Emergency Economic Powers Act, which temporarily lowered duties on Chinese goods. Manufacturers, seeing a brief window where the tariff environment was more favorable and fearing that conditions could tighten again, pulled forward shipments that were originally scheduled for later in the year. So exports, industrial production, port logistics, and raw material procurement all spiked in the same window. On the surface, it looks like global demand for Chinese goods just roared back. But dig a little deeper, and you'll find that a significant chunk of it was simply exporters front-running their own future orders. And there is actually a hidden fifth layer. The National Bureau of Statistics quietly adjusted the methodology for calculating fixed asset investment. One important reason that investment data managed to post positive growth was that the Statistics Bureau revised the statistical scope of fixed asset investment based on the fifth National Economic Census. They folded sectors like utilities, electricity, gas, and water, which are more stable and easier to show growth in, into the broader infrastructure investment category. That mechanically lifts the infrastructure numbers, which in turn makes the total investment figure look prettier. So when you add it all up, what we're seeing in China's January-February 2026 data is not a natural, market-driven recovery. It is the combined effect of upstream price hikes forcing inventory builds, policy stimulus being front-loaded to pump up credit and project activity, a calendar quirk inflating the production rhythm, a tariff window triggering an export rush, and a statistical methodology adjustment smoothing out the numbers. Several forces acting in concert to manufacture the illusion of economic recovery. But here is the problem. Artificially inflated data doesn't hold up under scrutiny. On the surface, things look encouraging. Industrial output is growing. Investment has turned positive. Trade is booming. Credit is flowing. 9.6 trillion yuan in social financing over 2 months, and M2 growing at 9%. Money is going out. Projects are starting, exports are shipping. It almost looks like the economy has genuinely caught fire. But these numbers only prove one thing, that policy and credit can drag top line indicators upward. They do not prove the far more important thing, that real market demand has recovered, or that private sector confidence is actually rebuilding. And the moment you go looking for answers to those two questions, you immediately find that every single structural problem dragging down China's economy remains completely unresolved. The most glaring one is still real estate. In the first 2 months, nationwide real estate development investment was down 11.1% year over year. New commercial housing sales by floor area fell 13.5%. Sales revenue dropped 20.2%. And in February, new home prices fell 3.2% year over year. The steepest decline in 8 months. The signal is unmistakable. No matter how much credit you pump into the system, it is not ordinary people going out to buy homes. Developers haven't regained any long-term confidence just because the government moved stimulus forward. The financial system is still releasing liquidity. But that water isn't flowing into the household sector or the property market. It hasn't reignited the one industry that historically drove wealth effects, local government revenues, and investment up and down the supply chain. As long as China's real estate market hasn't genuinely bottomed out, this surface level strong opening simply cannot translate into a solid, sustained recovery. Look a little deeper and you'll also find that private sector confidence hasn't returned either. Although overall fixed asset investment turned positive, private fixed asset investment was still down 2.6% year over year. That means the entities actually investing right now are the government, state-owned enterprises, and the specific industries receiving targeted policy support. Private businesses are still shrinking, not investing, not hiring, not expanding. If this economic recovery were real, what we'd expect to see is private business owners willing to borrow, willing to compete for equipment, willing to make medium and long-term bets. Instead, what we see is policy pushing certain sectors forward while the entire private economy stays flat on its back. Social financing totals may look healthy, but the structure is anything but. The economic data might look decent, but the private economy is contributing nothing. Consumption tells the same story. Retail sales in the first 2 months grew 2.8%, an improvement from December's 0.9%. And on the surface, it looks like holiday spending was robust. But domestic passenger car sales fell by about 19% over the same period, according to the China Passenger Car Association, with domestic-only vehicle sales plunging even further. That tells you what is actually recovering is limited to festive, occasion-driven spending, restaurants, travel services tied to the holiday season. It is not a sign that overall household purchasing power or long-term spending willingness is improving. Think of it this way, people will still go out to eat and visit family during the new year. That kind of spending happens regardless, but asking them to buy a home, buy a car, or make any major purchase that requires confidence in future income, that is a completely different story, and it is just not there. So once you line up all of these data points, the logic becomes very clear. China stacked multiple layers of artificial boosting onto its economic numbers to drag them upward in the short term. And yes, with enough engineering, you can make the data look better for a couple of months. But these numbers were manufactured through technical means. They have nothing to do with genuine economic recovery. Strong social financing only proves money was released. Infrastructure spending only proves the government is propping up the floor. Export surges may just be front. Running a tariff window, strong industrial output might just be inventory restocking and policy-driven production in priority sectors. Meanwhile, real estate is still falling. Private investment is still shrinking. Household big-ticket spending is still dormant and medium to long-term confidence has not returned. That tells you the so-called strong start to 2026 is really just a policy-engineered mirage that the Statistics Bureau and state media are trying to pass off as a genuine recovery. At the end of the day, you can package the data, you can tweak the methodology, you can orchestrate the messaging, but what you can't fake is how ordinary people actually feel about the economy. Take a look at what has happened to the A-share market. It has tumbled again. Domestic fuel prices have climbed to around 9 yuan a liter. People's wallets keep getting thinner. Where exactly is this economic recovery? It is nothing more than technocrats once again putting on a masterclass in Chinese-style statistical theater.